Welcome back to UK Property Info. Today we are diving deep into one of the most significant shifts we have seen in the rental market for years. Tenant demand has fallen by approximately 20% compared to this time last year. That is a substantial drop by any measure. But here is what makes this story truly fascinating. Landlords are responding in ways that defy conventional economic logic. Some are selling, some are holding. And surprisingly, some are buying more. Understanding what landlords are doing next and why they are making these choices is absolutely crucial for anyone trying to navigate this changing market. Whether you are a tenant wondering what happens to your housing options, a landlord questioning your own strategy, or an investor trying to spot opportunity in the chaos, this analysis will give you the clarity you need. Let us start with the demand picture, because understanding why inquiries have dropped 20% is essential context for everything that follows. The mainstream interpretation of this data suggests the rental crisis is easing. Headlines are appearing that celebrate the end of bidding wars and the return of choice for tenants. Some commentators are suggesting we are finally seeing a return to normality after years of dysfunction. But I want to offer you a more nuanced reading of what this 20% drop actually represents. Because when you look beneath the surface, the story is far more complex and far more concerning than a simple market correction. The 20% drop in tenant inquiries does not mean 20% fewer people need housing. The underlying demand for shelter remains as strong as ever. Population continues to grow. Household formation continues. Young people still want to leave home and establish independent lives. What has changed is the ability to participate in the rental market at current price levels. After 3 years of rent increases that have pushed average rents up by 30 to 40% in many areas, a significant portion of the population has simply been priced out of the market entirely. They still need housing, they still want to rent, but they cannot afford what is being asked. This is demand destruction through unaffordability, not demand satisfaction through successful housing outcomes. When we examine where this priced out demand has gone, the picture becomes even clearer. We are seeing record numbers of adults in their 20s and 30s moving back in with parents. These are people who had established independent lives, who were renting successfully, who have now been forced to surrender that independence because the combination of rent and living costs has become mathematically impossible on their incomes. We are seeing unprecedented levels of flat sharing among people who would previously have rented alone. Single professionals are doubling up with friends or strangers, splitting rent on properties that one person used to occupy. A 2-bedroom flat that housed 2 separate tenants in 2 separate properties now houses 2 people in one property. The demand appears to have halved, but housing consumption has simply been compressed. Now here is where the landlord response becomes absolutely fascinating. In a normal market, a 20% drop in demand would lead to a straightforward set of responses. Landlords would reduce rents to attract the remaining tenants. Competition for tenants would increase. Prices would fall until supply and demand found a new equilibrium. Some marginal landlords might exit, but the majority would adjust and continue. That is how markets are supposed to work. But that is not what we are seeing in the current environment. The landlord response is fragmented into several distinct strategies, each driven by different circumstances and different calculations about the future. The first group, representing approximately 28% of landlords, according to recent survey data, are continuing to sell despite the demand drop. This seems counterintuitive at first glance. Why would you sell when competition for tenants has reduced? Surely this is the time to hold on, enjoy easier lettings, and wait for the market to recover. But these landlords are not responding to demand conditions. They are responding to structural factors that exist entirely independently of how many tenants are inquiring about their properties. The financial mathematics that made their investment unviable when there were 40 applicants per property are still unviable when there are 20 applicants. Interest rates have not fallen. Section 24. Tax treatment has not changed. Regulatory requirements have not reduced. The Renters' Reform Bill is still coming. A landlord who is losing money every month is still losing money every month, regardless of whether the market feels less frantic. Let me illustrate this with specific numbers. Consider a landlord who purchased a property 5 years ago with a buy-to-let mortgage at 2% interest. Their monthly payment was perhaps £600. Rental income of £1,200 left comfortable margin after costs. That same mortgage coming up for renewal today faces rates of 5.5% or 6%. The payment jumps to perhaps £1,500. Suddenly the landlord is paying out more than they receive in rent before accounting for any other costs whatsoever. Maintenance, insurance, void periods, management fees all push the position further into loss. Whether there are 50 tenants or 15 tenants queuing for the property changes nothing about this fundamental arithmetic. The 20% demand drop does not make an unviable investment suddenly viable. The second group of landlords, representing around 43%, according to the same survey data, are planning significant changes to their approach without necessarily selling. These are landlords who are adapting their strategy to the new market conditions. Some are adjusting rents for the first time in years, accepting that the peak prices achieved during the frantic competition of recent years may no longer be achievable. Others are investing in property improvements to justify premium rents in a more competitive market. Some are shifting from long-term lets to short-term or holiday lets where regulations and returns differ. Others are restructuring their portfolios, selling poorly performing properties to pay down debt on better ones, creating a smaller but more sustainable business. This adaptation group is particularly interesting because their behaviour reveals something important about the nature of the current market. These are landlords who believe the fundamentals of rental property investment remain sound, but who recognise that the operating environment has changed permanently. They are not waiting for a return to the conditions of 2019 or even 2022. They are reshaping their businesses for a new reality where costs are higher, regulations are stricter, and tenant competition is less intense. Their continued presence in the market, albeit in adapted form, suggests they see a viable long-term future that is worth restructuring to capture. The third group is perhaps the most surprising. Approximately 19% of landlords surveyed are actively looking to buy additional properties. In a market where demand has fallen 20%, and fellow landlords are selling in record numbers, nearly 1 in 5 landlords sees opportunity rather than threat. Who are these buyers and what are they seeing that others are missing? The answer reveals important truths about how property investment actually works for different types of operators. The landlords buying in the current environment share certain characteristics. They typically have lower leverage, meaning less mortgage debt relative to property values. Some are cash buyers entirely, insulated from interest rate movements that are crushing more heavily borrowed competitors. They often have longer investment horizons, measuring returns over decades rather than years. They understand that property investment has always been cyclical and that the best buying opportunities often come when others are forced to sell. They are looking at landlords exiting under financial pressure and seeing discounted assets that will generate strong returns over a 15 or 20-year holding period. These opportunistic buyers are also making a calculation about future supply. They recognise that the landlord exodus is permanently removing properties from the rental sector. 2/3 of landlord sales are going to owner-occupiers, who will live in the properties rather than let them. The rental stock is shrinking by hundreds of thousands of properties. When the current affordability crisis eases, whether through wage growth, rent stabilisation, interest rate cuts, or any combination, demand will recover. That recovering demand will meet a significantly smaller supply of rental properties. Rents will rise again. Investors who bought at current levels, particularly those who bought from distressed sellers at discounts, will benefit substantially. The regional dimension of landlord responses adds another layer of complexity. In London and the South East, where yields have historically been lowest and price appreciation highest, the exodus is most pronounced. Landlords who bought for capital growth are finding that growth has stalled while costs have spiralled. The mathematics simply do not work at current prices and interest rates. Selling makes sense even at reduced prices because the alternative is ongoing losses. In the Midlands and North, where yields have always been higher, more landlords are choosing to hold or even buy. A property generating 7 or 8% gross yield can still work even at higher interest rates, particularly for landlords with substantial equity. Scotland presents its own unique dynamics. Rent controls implemented by the Scottish Government have created additional uncertainty that is accelerating landlord exits there. When governments cap what you can charge while costs continue rising, the mathematics become impossible for many operators. The 20% demand drop in Scotland is meeting an even faster supply contraction, creating a particularly acute imbalance. Wales has implemented its own licensing and regulation regime that adds to the burden on landlords operating in the Principality. The complexity of operating across different regulatory jurisdictions is pushing some landlords to concentrate their portfolios in single nations or even single local authority areas. What does all this mean for tenants navigating the current market? The 20% demand drop is real and is creating some genuine relief in the most pressured areas. Properties are taking longer to let. Some landlords are reducing asking rents. The frantic competition of recent years has eased, but tenants should not mistake this cyclical easing for structural resolution. The underlying supply situation is deteriorating. Every month, more properties leave the rental sector than enter it. The landlords buying opportunistically are not replacing the volume being lost. When demand recovers, and it will recover, it will meet a smaller supply of properties. The current relative calm is a window, not a new normal. For tenants in stable tenancies, my advice remains consistent. Protect that tenancy. Do everything you can to be the tenant your landlord wants to keep. Pay rent reliably and on time. Communicate openly about any issues. Report maintenance problems promptly but reasonably. Do not assume that falling headline demand means you can easily find alternative accommodation if your current situation ends. The market remains extremely challenging for anyone actively searching. If your landlord is selling, understand that you have rights and timelines. Do not be rushed into decisions. But also be realistic that finding replacement accommodation at current rent levels may be difficult. For tenants currently searching, the 20% demand drop does create some opportunities. You may face less competition than applicants experienced 12 months ago. You may have more time to consider options rather than making instant decisions. Some landlords may be negotiable on rent in ways that would have been unthinkable during the frantic market. But you still need to present the strongest possible application. References, proof of income, deposit funds ready, professional communication. The fundamentals of successful applications have not changed, even if the intensity of competition has reduced. For landlords watching this analysis and considering their own position, I want to offer some honest perspective. The 20% demand drop does not fundamentally change the calculation you need to make about your investment. If you were profitable before the demand drop, you are probably still profitable now. If you were losing money before, you are probably still losing money. The question is not whether tenants are easier to find. The question is whether your specific investment works financially, given current costs, taxes, regulations, and realistic rent expectations. Only you can answer that question with full knowledge of your circumstances. For landlords considering selling, the current market presents both challenges and opportunities. Demand from owner-occupiers remains relatively strong, meaning your property may sell even if mortgage-dependent buyers are struggling. Pricing realistically for current conditions rather than holding out for peak prices will likely result in faster sales. The landlords who sell now, in an orderly fashion with time to optimize the process, generally achieve better outcomes than those forced to sell under time pressure. If exit is the right decision for your circumstances, executing it professionally makes sense. For landlords considering holding, the key question is sustainability. Can you maintain the property, meet your mortgage obligations, and cover operating costs from rental income plus whatever additional resources you are willing to commit? If the answer is yes, holding through the current difficult period may well prove to be the right decision. Property has historically rewarded long-term holders. The landlords who survived the early 1990s crash, the 2008 financial crisis, and other difficult periods generally saw their patience rewarded. But only you can assess whether your financial position allows you to be patient. For landlords considering buying, this is genuinely an interesting moment. Motivated sellers are bringing properties to market at prices that would have been unthinkable 2 years ago. Competition from other investors has reduced substantially. The opportunity to acquire good properties at discounted prices exists in a way that has not been true for over a decade. But buying successfully requires clear-eyed analysis. You need to understand the true costs of ownership, including realistic maintenance, void periods, and regulatory compliance. You need to stress test returns against further interest rate increases. You need to accept that capital growth may be limited for an extended period. If you can buy well, finance conservatively, and operate professionally, the current market offers genuine opportunity. The government response to these market dynamics has been characteristically inadequate. Policymakers looking at the 20% demand drop may conclude that the rental crisis is easing and reduce the urgency of intervention. That would be a catastrophic misreading of the situation. Demand has been destroyed by unaffordability, not satisfied by adequate housing. Supply continues to contract as landlords exit. The fundamental imbalance is worsening, not improving. Policies that further accelerate landlord exits without providing alternative supply will make the eventual reckoning more severe, not less. What happens next depends on factors that remain genuinely uncertain. If interest rates fall significantly, some landlords currently planning to sell may reconsider. If rates stay elevated or rise further, the exodus will accelerate. If the Renters Reform Bill is implemented in its current form, many landlords waiting to see final details will make exit decisions. If implementation is delayed or softened, some may stay. If wages grow faster than rents, affordability will improve and demand will recover. If the cost of living crisis continues, demand destruction will deepen. The range of possible outcomes remains wide, which is precisely why understanding the current dynamics is so important. The 20% demand drop and the fragmented landlord response it has triggered represents a pivotal moment in the UK rental market. The decisions being made now by landlords across the country will shape the rental landscape for years to come. Those who sell are permanently removing supply. Those who buy are positioning for future scarcity. Those who adapt are reshaping how rental property investment works. And tenants, whether they realise it or not, are navigating a market in fundamental transition. Thank you for watching this UK property info analysis. The market shift we are witnessing requires careful interpretation beyond the headline numbers. If you found this analysis valuable, please subscribe to the channel and turn on notifications so you do not miss future updates as this situation develops. Share this video with anyone trying to understand what is really happening in the rental market. Whether you are a tenant, a landlord, or an investor, understanding these dynamics is essential for making good decisions. Leave your thoughts in the comments below. Are you seeing this demand drop in your area? Are you a landlord adapting your strategy? Are you a tenant finding the market easier or still struggling? Your experiences help us understand the human dimension behind the data. Until next time, this is UK Property Info, helping you make sense of a market in transition.